Welcome back to the deep dive. It is Friday, February 13th, 2026. And honestly, looking at the charts this week, that date feels a little too on the nose, doesn't it?
It really does. It has that ominous, almost cinematic ring to it.
Yeah.
Usually Friday the 13th, that's for slasher movies, bad decisions at summer camp. But this week, the script was definitely being written by the stock market. We have seen a week of just absolute carnage.
Carnage is the right word. I mean, I was looking at the aggregate numbers right before we turned the mics on, and I seriously had to double check my terminal. I thought it was a data glitch.
It's a number so big it doesn't even feel real.
$2 trillion. That's $2 trillion with a capital T just erased from software market caps in a few days.
That's the GDP of a G7 country. Just gone.
Yeah.
It's We're talking about a level of downside volatility that we haven't seen in tech since, I don't know, maybe the early 2020s.
Or even the dot-com unwind, maybe.
You could make that argument, though the fundamentals are totally different now. But, and here's the twist for our Friday close today, offered a little bit of a, let's call it a plot twist.
We finally got a bounce, a little heartbeat on the flat line.
A slight rebound, yeah. A short-term reprieve. And while the headlines are still, screaming about an AI apocalypse, and we're definitely going to get into that.
Oh, yeah.
The bond market is quietly in the corner, celebrating a major macro victory today. It's like we have two completely different markets operating in parallel universes.
Exactly. It's this weird split-screen reality. On one side, you have equity investors just terrified that AI agents, and specifically this new Claude Cowork thing, are going to just butcher traditional business models.
Right.
And on the other side, the macroeconomy seems to be getting the all-clear, the green light we've all been waiting for on inflation.
Precisely. And so our mission for this weekend edition of the Theta Fuse is to help you navigate that exact chaos. We're not just going to stare at the wreckage. We're going to look for the opportunities, because when you get this kind of dislocation, macro good, micro terrifying, that's usually where the alpha's hiding.
Okay, so we're going to unpack the Friday close. We're going to dissect this AI panic that is spreading to some, frankly, very surprising new sectors. It is not just tech anymore.
Not even close.
And then we are going to arm you with the Theta strategy for the weekend. Because when fear spikes, implied volatility.
It also spikes.
Yeah.
And when volatility spikes, those option premiums get very, very expensive. We want to be the ones selling that expensive insurance, not the ones panic buying it.
Exactly. So here's the roadmap. First, we're hitting that macro green light, the CPI data that dropped this morning. Then we're going deep into the AI scare trade, that contagion spreading from trucking to wealth management.
And finally, the solution. The high ID plays, the put-selling strategies to take into the weekend.
Let's do it.
Sounds like a plan. Let's get into it.
Okay, let's kick it off with the big macro news. The January 2026 CPI report. It dropped today, and, after the week we've just had, the market needed a win. So what did the numbers look like?
They looked good. Better than good, really, depending on how deep you want to dig. The headline CPI year over year came in at 2.4%.
2.4. Okay. And the street was looking for what, 2.5?
Yeah, consensus was 2.5%, so we beat the number. And maybe more importantly, that's down from December's 2.7%. The trend is our friend here.
2.4%. That feels, I don't know, manageable. It feels like we are finally in striking distance of where we actually want to be. It doesn't have that scary 3 or 4% handle anymore.
We are right there. And if you look at the core CPI, which strips out the volatile food and energy, that came in at 2.5%.
Okay, so a little hotter than headline.
A little hotter, but it matches expectations. And here's the key. It's the lowest level for core CPI since March of 2021.
March 2021. Wow. So think about where we were then. That was before the big inflation surge really took hold.
We are essentially turning back the clock 5 years on core inflation. This should be the green light that the bulls have been absolutely desperate for. This is the trajectory the Fed wants to see. It's cooling, and it's cooling faster than a lot of people anticipated.
That's got to be the narrative.
It is the narrative. This is the confirmation. But, you know me, I can't let us just celebrate without looking at the caveats.
Of course not. There's always a but.
There's always a but, because the devil's in the details. If you just read the headline, you miss the friction happening underneath.
Yeah.
While the overall number is great, we still have some of these sticky components that just refuse to go down.
Let me guess. We're talking about housing again.
We are always talking about housing. Shelter costs rose 0.2% month over month. They're still up 3% annually.
Which, 3% doesn't sound like hyperinflation, and not compared to what we saw a few years ago.
No, it's not the 8 or 9% peaks for sure. But you have to remember, shelter makes up about 35% of the entire CPI index. It's the heavyweight champion of that basket. So if shelter doesn't really move, The index doesn't move as much as we want it to.
And it's so frustrating because, as we've talked about so many times, interest rates are just such a blunt instrument for fixing housing prices.
Exactly. I saw a great line in one of our sources today that put it perfectly. Monetary policy can't build apartments.
Right.
The Fed can raise rates to crush demand or cut them to stimulate it, but Jerome Powell can't put on a hard hat and start pouring concrete. He can't fix the supply side. So as long as supply is tight, those prices are just going to remain stubborn.
So housing is the sticky part.
Okay.
But there was another index that kind of caught my eye in the report, the personal care index.
Ah, yes. My personal favorite, the expensive haircut index.
That's what it is. It's up 5.4% year over year. I'm talking haircuts, toothpaste, manicures. Why is that one specific sector running so hot when almost everything else is cooling off?
It all comes down to the service sector, and specifically personal services. I mean, this is labor-intensive stuff. You can't really automate a haircut.
Not yet, anyway.
Not yet, despite what the AI panic might suggest. So wage pressures, they show up here first, and they're very direct. If your barber is paying more for rent and for food, your haircut is going to cost more. It's a direct pass-through.
So that's the super core inflation we hear about.
That's it. It's the hardest part to kill.
Okay, so we have sticky housing and we have expensive toothpaste. But to get down to a 2.4% headline number, something has to be crashing to offset it. Who are the deflationary heroes in this story?
This is where the consumer is actually feeling some real relief. Gasoline is down 7.5% year over year.
That's huge for the weekly budget.
Huge. Used cars are down 1.8%. And here's the big one, eggs.
The egg saga continues. I was waiting for this.
It does, but finally in a good way for consumers. Eggs are down 34.2%.
34%. That's not a drop. That's a crash.
It's the unwinding of that massive supply shock. Remember the avian flu outbreak? It just decimated the flocks, supply plummeted, prices went to the moon.
Right.
Now the flocks have recovered, supply is back, and prices are cratering back down to earth. It's a perfect Econ 101 lesson. But here's the big takeaway. The goods economy stuff you can buy in a box or a carton that's in deflation, the services economy stuff you need a human for, is still inflationary.
Okay, so we've got cheap eggs and cheap gas balancing out the expensive rent and haircuts. How did the market take all this? Because usually, the stock market and the bond market tend to see things a little differently.
Oh, they definitely did this week. The bond market absolutely threw a party. Treasuries rallied hard, which of course means yields dropped.
Yeah.
The two-year yield fell to around 3.4%.
3.4, that's the lowest it's been since what, last October?
Lowest since October, yep.
And for our listeners who might not be watching the two-year yield every single day, I know, shame on you. Why does that specific number matter so much?
Because the two-year yield is essentially the market's real-time prediction of what the Fed is going to do in the near future. It is the most sensitive part of the curve to Fed policy. So when the two-year yield drops like a stone, that is the bond market screaming at the Fed, you are going to cut rates and you are going to do it sooner than you think.
It's front-running the Fed.
Completely front-running the Fed.
Yeah.
The market has aggressively repriced the odds for rate cuts. I mean, before this report, there was some real anxiety that maybe the Fed would stick to its higher for longer mantra.
Right.
Now, the market's looking at that March 18th meeting and saying, okay, there's a 92% chance they pause. They hold steady.
But the pivot is coming.
The pivot is coming. June 2026 is now the heavy favorite for the first cut. We're seeing probabilities anywhere from 63% to 83% for a cut by June. The bond market is validating this disinflation trend. It's saying, we believe the 2.4% number more than we believe the Fed's tough talk about normalization.
Okay, so macro-wise, we have a green light. Inflation is cooling down. Rates are likely coming down by summer. You would think the stock market would be absolutely mooning. You'd think the NASDAQ would be ripping to all-time highs. But it's not.
Not at all.
And that brings us to the elephant in the room, the AI panic.
The AI scare trade. It's so fascinating because it's completely counterintuitive to what we saw in 2024 and 2025. Back then, AI was the magic word. You just had to say AI on an earnings call and your stock popped 10%. It was a pure hype cycle.
And now it's the opposite. It's fear. It's the fear of displacement. And we have a villain of the week, don't we?
We do. Anthropic, specifically their Claude Cowork agent plugins.
Claude Cowork. I mean, it sounds harmless. It sounds like a helpful little assistant that's going to organize your calendar for you.
And that's the irony, right? It is a helpful assistant.
Yeah.
But the capabilities are what has terrified investors.
Mm.
The entire narrative shifted this week from AI will help us work better to AI agents will butcher traditional business models.
And investors are in sell first, think later mode.
Completely. No questions asked.
So let's trace the path of this contagion because it started in some pretty specific sectors and it is just spreading so fast. We talked earlier in the week about logistics.
Right. Trucking and logistics. Landstar, so that's LSTR, and C.H. Robinson, CHRW. To understand the panic here, you really have to understand what these companies actually do. They're freight brokers.
They're the middlemen.
Exactly, they're the middlemen. They connect a company that has stuff to move. Let's say Target needs to move widgets from a port to a warehouse with a trucker who has an empty truck.
It's just a matching game.
It's a matching game that right now relies on a ton of phone calls, emails, load boards, negotiation. It's full of friction. And C.H. Robinson takes a margin for managing all that friction.
And the fear is that an AI agent can do that matching instantly for basically free without a millman taking a cut.
Exactly. I mean, if Claude Cowork can scan all the load boards, negotiate the rate via an API, check the driver's insurance, and book the load in, 3 seconds? Why are you paying C.H. Robinson at 15% margin?
And that's the fear that caused LSTR to drop, 15.6% on Thursday?
0.6% on Thursday. A massive, massive move for a logistics company. These aren't normally volatile tech stocks. They're supposed to be boring industrials.
But we did see a little bit of a recovery there today on Friday.
A little. LSTR was up about 1.2%. CHRW was still struggling a bit. But it wasn't just trucking. It moved to real estate.
CBRE.
CBR Group.
Yeah.
The absolute giant of commercial real estate services. And the fear here is very similar. Automating property valuation, automating the deal-making process.
So if you can automate the due diligence and the paperwork,
which is what thousands of junior brokers do,
then do you need that army of brokers?
That's the question. And that fear sent CBRE plummeting 8.8% on Thursday. But, and this part is interesting, it rebounded significantly today. It was up 4.8%.
Okay, so the value investors stepped in on real estate. They looked at that massive drop and said, all right, this is an overreaction. Humans still need to shake hands to buy a skyscraper.
Precisely. Real estate is still very high touch. But here's where it gets really, really interesting, and this is the critical new information for today. The contagion did not stop at logistics and real estate. It jumped the fence.
Where did it go?
It went straight into the financial sector.
The wealth managers.
The wealth managers.
Yeah.
We're talking about the stalwarts here. Charles Schwab, LPL Financial, Raymond James. I mean, these are the firms that manage trillions of dollars of American wealth.
And Schwab fell, about 10% this week alone?
Around 2%, yeah. And the logic is the same relentless, brutal question. If AI can do sophisticated tax planning, if it can handle your portfolio allocation, if you can rebalance your 401k automatically based on your risk tolerance, do you need the financial advisor?
Do you need the middleman taking that 1% fee every year?
Exactly.
Wow, that cuts deep. Because for so long, the argument was always AI can't replace the human touch. Clients want to talk to a person when the market crashes, but the market is betting that. Maybe they don't, or at least maybe they won't pay as much for it.
The market is re-rating the value of the middleman. It's looking at every single industry and it's asking, is your primary job processing data and connecting two parties? And if the answer is yes, the market is showing absolutely no mercy. It is pricing in massive margin compression. Maybe Schwab doesn't go out of business, but maybe they can't charge the fees they used to, and that changes the valuation model entirely.
And there's a second layer to this financial contagion, right? It's not just the stockbrokers, it's the lenders. Private credit. This is a topic we haven't touched on a lot, but the numbers here are just staggering.
This is such a crucial, sophisticated point that I think a lot of retail investors are missing. We saw firms like Ares, Blackstone, Blue Owl, Apollo. I mean, the absolute titans of private credit slump between 13% and 24% this year.
Wait, 24%? That's not a slump, that's a crash. Why is private credit getting hit so hard by an AI software panic? These guys just lend money. They aren't writing code.
It's all about the exposure. You have to ask the next question. Who did these private credit firms lend all that money to?
They lent it to the software companies.
Bingo. About 1/5 of the entire private credit space is exposed to the software sector. During the boom years, these lenders just poured billions and billions into SaaS software as a service companies. They were lending against annual recurring revenue, or ARR.
Right. The pitch was, oh, you have subscription revenue. That's as good as gold. Here's a $500 million loan.
Exactly. But now, those same SaaS companies just lost $2 trillion in market cap. Their valuations are being slashed because the market thinks their product is about to be made obsolete.
So if the equity value of a software company goes to zero because Claude Cowork replaced their product,
Then the lender who funded them is left holding a very toxic asset. It's a second-order effect. The software crash is rapidly becoming a credit risk event.
so if I'm getting this right, the market is panicking that the software companies will fail, and then if they fail, the private credit guys don't get paid back.
That is the fear in a nutshell. It's a domino effect. Software gets disrupted, which means software revenue falls, which means the software companies can't service their debt, which means the private lenders take massive losses. The market is pricing in that entire chain reaction right now. And it's arguably the biggest risk out there because private credit is so opaque, we don't really know how bad the loans are until they default.
That is heavy. It really paints a picture of why this sell-off feels so different. It's not just, oh, tech is overvalued. It's the fundamental structure of the economy is changing.
It is a structural re-rating.
Right.
But as traders, and specifically as theta traders, we know that panic usually creates opportunity. When everyone is running for the exits, the premiums on the options get very, very juicy.
Which brings us perfectly to the theta strategy. This is the solution part of our deep dive. We have the macro green light. We have the sectoral panic. How do we play this for the weekend and into next week?
We lean into the fear. We sell the exhaustion. The core concept here is implied volatility, or 5E.
Okay, let's define that really clearly for anyone who might be new to this.
So implied volatility is essentially the market's expectation of how much a stock is going to move in the future. When investors are terrified, they buy puts to protect themselves. That demand for puts goes way up, and that drives up the price of those options. So IV goes up.
It's like the price of insurance goes up because everyone thinks the hurricane is coming.
It skyrockets. And we want to be the insurance company. We want to be the ones selling those expensive puts, not buying them. We're selling fear to people who are desperate to buy safety.
Okay, so let's look at some specific tickers that were highlighted in our strategy session. We talked about Landstar, LSTR.
LSTR is a classic selling exhaustion setup.
Right.
It fell 15% on Thursday. That's a capitulation move. That is people just puking up their shares because they want out no matter the price.
Right.
Then on Friday, it stabilized. It was up 1%. That little green candle tells me the initial wave of panic selling might be done. The weak hands are out.
So the trade is to sell a put. How does that work?
You sell a put below the current price. Let's say the stock is trading at $150. You could sell the $140 put for next month. You're essentially betting that Landstar won't fall another massive percentage in the next few weeks. And because the IV is so high from that recent crash, you get paid a very, very healthy premium for taking that bet.
You're collecting that fear premium.
That's it, exactly.
Yeah.
And if the stock just sits there, or it goes up a little, or even goes down a bit, but stays above your $140 strike price, you keep all of that money. That's the beauty of Theta. Theta is at the time decay. Every day that passes where the stock doesn't crash, that option loses value, and you make money. Time works in your favor all weekend.
I love that. Okay, what about the software sector itself? You mentioned Salesforce, CRM. That's right in the eye of the storm.
Salesforce is the poster child for this whole mess. I mean, software valuations are down 33% since October. Citi actually put out a note calling this a selling crescendo.
Which is just analysts speak for everyone who wanted to sell has probably sold.
Pretty much. So is it safe to touch?
That's the question.
Safe is always a relative term in a market like this. But the risk-reward has definitely shifted. If you believe Salesforce isn't going to zero, if you believe companies are still going to use CRMs 5 years from now, then selling puts on these blue-chip tech names is becoming very attractive. You getting paid to buy them at a discount if they happen to fall further.
Let's talk about the wheel strategy for a minute. We have listeners with all different kinds of risk tolerances. Some want steady income, some want to try and catch a falling knife very carefully. Let's start with the conservative plays.
Okay, for the conservative income seekers, you want low volatility, steady eddies. The sources point to the usual suspects: Coca-Cola, AT&T, and Pfizer, PFE.
Right. Coca-Cola is probably not going to be replaced by an AI agent anytime soon. I haven't seen an AI drink a soda yet.
Not yet, no. People still drink soda. These stocks didn't crash this week. They're defensive. But because the overall market anxiety, the VIX, is up, their premiums are slightly elevated too. It's a safe way to generate cash flow. You sell a put, you collect the premium. Worst case scenario, you get assigned and you own Coca-Cola at a discount, which is stock you probably don't mind holding forever anyway.
Okay, and for the more aggressive listeners, the ones who are willing to step in front of the train.
Then you look at the names that have been absolutely punished. Atlassian, Team.
Oh, they have been crushed. Utterly
down
crushed.
47% year to date. I mean,
Yeah.
that is a bloodbath. But, and this is the key, analysts have a strong buy rating on it following an earnings beat.
So you have a massive disconnect there. The price is crashing, but the fundamentals were actually pretty decent.
That is the divergence we look for. Exactly. So you could sell put on team, the premiums are going to be massive because the stock is so volatile.
Yeah.
But you have to be willing to own it if it keeps dropping. This is not for the faint of heart. Another one is Amazon, AMZN.
Amazon. That's interesting. I feel like Amazon usually holds up a bit better.
It usually does, but it's been caught up in this broader tech sell-off. So if you're a long-term believer in Amazon, using a cash-secured put here lets you potentially enter a position at a much lower cost basis than just buying the stock today. And you get paid while you wait.
I love that play. It's discipline accumulation. Now, I saw something absolutely crazy in the volatility scanner. Gossamer Bio. GOSS.
Oh, GOSS. This is for the thrill seekers only. The implied volatility on the puts is exceeding 600%.
600%. That sounds like a typo.
It is not a typo, it is biotech. That level of IV usually means a binary event is coming up, like an FDA approval or rejection. It means the market thinks the stock is either going to double or go to zero, basically overnight.
So selling options there is? What?
It's like picking up pennies in front of the steamroller, except the pennies are actually gold
Ew.
bars. But the steamroller is moving very, very fast.
Okay, so proceed with extreme caution.
Extreme caution. That is a pure volatility play, not an investment. If you do that, you have to do it small.
And what about Golub Capital? GBDC. Same idea.
Yes, GBDC is showing surging IV. It's in that distressed financial sector, that private credit space we talked about earlier. The market is pricing in a lot of risk on their loan book. High risk, high reward.
Okay, let's pivot to the one asset class that never ever sleeps. Crypto. We're heading into the weekend, stock markets are closed, but Bitcoin just keeps on ticking. What is the sentiment like over there?
Extreme fear. The crypto fear and greed index hit a record low today. It hit 5.
A 5 out of 100.
A 5. That is deep capitulation territory. Historically, when that index gets that low, it's often a pretty strong contrarian buy signal. It just means everyone is terrified and everyone who was going to sell has probably already sold.
Bitcoin's been trading in that, what, $65,000 to $69,000 zone? It feels like it's just holding its breath.
It is. The soft CPI print gave it a little bump today, pushed it briefly to 69,000, but it just couldn't hold. The issue right now is the ETF outflows. We're seeing some institutional money pulling back, likely just de-risking because of all the volatility in the broader tech market.
So what are the key levels to watch for the weekend?
Resistance is right at $70,000. We need to break that convincingly to flip bullish. But support is the real key here, $65,000. If we break below 65K, there are some liquidity zones down near $60,000 that could open up really fast.
So the forecast for the weekend is more chop.
Consolidation. I think it's likely to just bounce between, say, $66,900 and $68,150. It's a wait-and-see weekend for crypto. It's waiting for the stock market to figure out if the world is ending or not on Monday.
All right, let's zoom out and wrap this up. We have covered a lot of ground.
We certainly have.
It's been a wild week of AI panic, immediately followed by a soothing CPI print. You have the bond market basically saying soft landing, rate cuts are coming, everything is fine.
And then you have the stock market, or at least the software sector of it, saying AI is going to eat the world and destroy all the middlemen.
It's just a fascinating disconnect, and frankly, it raises a huge question for everyone listening.
Which is?
Well, what is it?
I think the question is, if wealth managers and private credit firms are crashing because of AI software, if the so-called smart money is terrified that their own jobs are becoming obsolete, are we all underestimating just how fast the real-world economy is about to change?
That is the chilling thought. Is the market overreacting right now, or is this the Napster moment for white-collar services? Are we just watching the CD store burn down in real time while we're all still checking the price of eggs?
We might be.
Yeah.
And if we are, this volatility is just getting started.
Well, on that cheerful note, we want to hear from you. The market is picking winners and losers fast. If you are holding a bag or watching a crazy ticker, drop it in the comments right now. We will pick the top 3 tickers and do a full Theta breakdown in our Monday episode. Make sure you are subscribed so you don't miss it.
Do it. We want to see what you're seeing out there. Have a great weekend, everyone.
Stay hedged.